This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the fourth Friday of February 2016. In the economy, inflation that Federal Reserve Chair Janet Yellen and her colleagues hoped for is happening faster than most economists expected. The Commerce Department reported prices of consumer goods and services excluding food and fuel rose 0.3% in January. This represents the biggest gain since 2012. That pushed costs up 1.7% over the past 12 months, already exceeding the 1.6% Fed officials forecasted for the fourth quarter of 2016. The U.S. economy unexpectedly expanded at a faster pace in the fourth quarter than initially expected, reflecting a higher value of business inventories. Gross domestic product, the value of all goods and services produced, grew at a 1% annualized rate compared with an initial estimate of 0.7%. The median forecast in a Bloomberg survey called for a 0.4% gain. With a wave of supply on the way, investors are demanding higher compensation to own California debt. The extra interest to hold 10-year California bonds instead of benchmark municipals rose as much as 31 basis points this week, the most since November, Bloomberg data shows. That's still low compared to other states. Illinois is paying a 165 basis point penalty on its 10-year securities, the most among the 20 states tracked by Bloomberg. This is due to a political stalemate that's left Illinois without a budget since July. That impasse has also slowed Illinois' borrowing. It has the least projected municipal debt issuance over the next 30 days. Only 12 states, led by California, have positive net supply next month. Treasuries fell after economic data that beat forecasts prompted traders to reevaluate their views on the Federal Reserve's interest rate path. Yields on two-year notes surged by the most since December, as traders ratcheted up bets on the pace of rate increases. That helped push the gap between yields on 2-year and 10-year notes to the narrowest since 2007 on a closing basis. Traders are evaluating their outlook for monetary policy before the Fed meets March 15th and 16th. Futures markets imply traders expect the next rate increase to be in the second half of 2017. U.S. stocks slipped on Friday while posting a second straight weekly increase. Equities struggled to add gains after a nearly 7% run-up since the S&P 500 reached a 22-month low. Optimism on the economy tempered after signs of firming inflation fueled speculation interest that Fed funds rates may rise sooner than previously expected. The S&P 500 index, topping its 50-day moving average, may be a sell signal. On Thursday, the index surpassed its mean over the last 50 days for the first time in 2016. That marks an end to the longest stretch since 2011 that the benchmark has traded below that technical level. The fact the 50-day moving average has been declining may be an indication the market is exhausted after a rebound that's lifted the S&P 500 to a 7-week high. That sums up your weekly market update ending the fourth Friday of February 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching and have a great week.